Welcome to Hot Takes Video Games. Today we will discuss Federal Reserve Chairman Powell's comments on future interest rates at Spelman College in Atlanta, Georgia. Please comment below on any thoughts you have about today's content. Community engagement and discourse are encouraged as I want to build lively discussions around these topics to better target content to you the viewer. Today's featured gameplay is from Titanic Honor and Glory, Demo 401, version 2 released in 2023 for the PC. On December 1, 2023, Chairman Powell sat down with Spelman College President Helene Gayle to discuss the current economic climate and provide his thoughts on current Fed policy. When asked if interest rates were going to come down soon, he said, "Not so fast." The Fed has held rates at their current level for the past 3 Fed policy meetings. The current rate is at the highest level they have been for the last 22 years. The next meeting is going to take place later this month, with the expectation that rates will be held at their current level. One group of people who are overly bullish are investors. They have already priced in the belief that interest rates will begin to decrease early next year. It's this continued belief, in my opinion, that has caused the markets to do so well this year. It almost defies the rules of business in a high-cost and high-interest rate environment, but the S&P 500 has returned 19.2%. Even with all the tailwinds this economy is facing, the market continues its rise. I do not believe this sentiment will last. Soon, reality will be once again injected into the markets. Diminished quarterly earnings cannot be ignored forever. Eventually, the large publicly traded corporations in this country have to show that they are producing value for their overvalued stock. The tricks of stock buybacks, to increase stock prices and dividends, can only continue for so long. Once the money dries up, it will be much more expensive for them to finance investment into these companies, which will further depress earnings. As you have probably noticed, it is much more expensive to finance anything right now. Home mortgages are averaging 7.36% this week. New car loans are hovering at 5.07%. Used car loans are hovering at 7.09%. If you think these average rates are high, these are rates for customers who have credit scores above 780. You will hear advice such as, "Just don't buy anything." To a certain extent, this is what is happening in both the housing and car markets. Home mortgage applications are at an all-time low. The refinancing mortgage business is non-existent. Many homeowners have been able to take advantage of the lower interest rates over the last 15 years, and they are not in a hurry to give up their rates. Buyers are getting hit with the worst of both worlds. They get to deal with historically high home prices, coupled with 22-year highs in interest rates. It is the most unaffordable time to buy a home since 1984. On the other side, you have home sellers who are locked into ultra-low interest rates and have enjoyed the appreciation in their home values over the last decade. In the short term, this might be feasible. However, in the long term, holding onto a home may be unsustainable. People's life circumstances change all the time. People have to move for a multitude of reasons. What if you have to move for a new job? What if you fall into unexpected health issues, or need to go into a long-term care facility? What if you lose your job and can't find one to sustain the costs of owning that home? When that inventory does eventually make it onto the market, there will not be enough buyers in many areas to buy those homes. Once inventory increases and no one is there to buy, then the sellers will have no choice but to lower the price if they want to sell the home. The real question is who can hold out longer? The Fed or individual homeowners? My opinion is that individual circumstances will force sellers to lower their prices in the medium term. It takes time for trends to develop in the housing market. Some markets are down this year. Others have been resilient. However, I do think that eventually, home price declines will spread across the nation. Some markets will take bigger hits than others, but I think everyone will feel some of the pain. The car market is in a similar situation. If you are in the market for a new car, you will notice that prices have gone up considerably over the past few years. I recently purchased a 2023 Chrysler Pacifica Hybrid. The cheapest trim of that van is $53,420 for the 2024 model year. If you bought the same van in 2020, you would have paid $39,995, or roughly at 25.1% less. Did I get 25% more van for the money? No, I did not. Although the higher interest rates cause borrowing money to cost more, prices of goods and services need to come down, as these are also unsustainable for the average American. The amount of inflation in almost every sector is still too high to be sustainable. Assets such as homes and stocks have a long way to go until they are back in line with historical norms. One way for normal people such as us to capitalize on the current conditions is to put more money in savings accounts or government treasury bills. As you can easily find rates at or above 5% on these. Unheard of just a year ago. I think if the Fed reverses its tightening policy too soon, assets that are already overinflated will continue to inflate higher, bringing home ownership and a secure retirement further out of range for your everyday citizen. Viewers, what do you think? Do you think the Fed will lower rates soon? How has higher rates affected you and your families? If rates are lowered, will your life be affected by the change? Please feel free to comment below. It's community engagement that helps small channels like mine grow. Thanks for joining me today. Take care, I will see you at the next video.